If unemployment in this economy was 7%, kaboom, it's over.
At some point in time, people are going to back off our bonds, the demand's going to wane, and the Fed's going to come back in to support it, at which time the dollar gets crushed.
I can't figure out intuitively how China buying gold is a collateral move. They're valuing it above market, and that would be a dollar threat.
You say Bitcoin is your number one holding, but it's not the best risk-adjusted return over the last couple of years.
When I say Bitcoin's my biggest, it ain't biggest by much.
Amazon just announces today that they're getting rid of 30,000 employees. I assume part of that is AI filtering in, and the supply side solutions to inflation that Trump and Stephen Moore and Larry talked about could be affecting in 2026.
They're going to have to print so much money to keep the banking system from collapsing due to AI. The Fed's balance sheet's going to have to go to a number that blows people's minds.
Welcome to the Futures Edge. I am Jim Iuorio. That's Bob Iaccino. You all know who that other guy is, but I'll intro him in 1 second. And before I do, a special thanks to all of you guys. I love doing these shows live. I love all the interactions. Thank you guys so much. To our sponsors. First, Independence Arc. We talk about how big companies have taken over the food supply in our country, and they're doing us harm. They are. There is something you can do about it, and that's to patronize small independent farms like Independence Arc. Also, our main sponsor, unfilteredinvestor.com. If you guys haven't been to that website yet, please do. Mike and Bobby are killing it. And it has been a pleasure to be with them on that ride so far. You all know who that is. It's founder, president of Forest for the Trees, and the author of the Mr. X interviews. And he did a podcast on Macro Voices about 3 weeks ago that kept me up at night for 3 days. And I will try to find the silver lining in all the shit. But that is Luke Gromen. How are you, Luke?
I'm great, Jim. How are you doing?
Well, my wife just built this new studio for me that's like, I call it the dungeon. It's cold as hell in my basement, but she wants me out of her hair. So this is the first time broadcasting from this. So how's the shot? Everything look good, Bobby?
Everything looks good, man. Except that ugly Illinois stuff. You got to get some Buckeyes there.
That.
You see the Chief. You see the Chief, right?
There he is. Go Buckeyes.
Where'd you go again? You went to in school in Ohio?
I went to the number 17 Cincinnati Bearcats.
Nice.
Bearcats, nice.
Yes.
Illinois' football team turned out to not be what they thought, but the basketball team, I think, is solid. So,
yeah, that was a surprise. I remember oh, look at this Illinois-Indiana game. This is gonna be a good one. And I was like,
I turned it off in the first quarter.
I think I was out somewhere. I was like, what happened? Like,
what is happening here? Anyway, okay, let's get down to it because I think this could be a tremendous conversation, mostly because something has changed since you talked on Macro Voices before. But can you walk us through one point you made on Macro Voices is that we have kind of given China the leg up for 3 decades on things like rare earths, the supply chain. How screwed are we and how do we work ourselves out of it? Is that too broad a question or no?
No, it's good. How screwed are we? Look, it's never about if we're screwed or not. It's sort of like who is, the rock is falling. Whose head is it going to fall on, right? So it's, or what's normal for the spider is chaos for the flies. Look, if we want to try to pretend like we can maintain the real value of the bond market as we have pursued policy over the last 40 years, which was essentially offshore the defense base, offshore factory jobs, middle-class jobs to China, all in the interest of basically subjugating the middle and working class to support Washington deficits and Wall Street and the bond market, then we're screwed. Like, we're going to lose. That's a world where China is going to make more and more of our defense base for us over time. And we're going to get more weeks and more months in the like we've had in the last month, which is, hey, China cuts off rare earths and everybody throws a fit like an alcoholic who's been cut off from a supply. Now, if we are willing to subjugate the bond market to support middle working class jobs and the reshoring of the defense industrial base, which is what I think is underway, not as quickly as I would like, but it appears to be underway, then the rock's going to fall on the head of the real value of bonds. Basically, what has been good for, what's been good for Goldman Sachs has been good for America for the last 20 years. And I think we are in the very early innings of what's good for the the industrial base, the defense industrial base, wage earners in this country, is what's good for America. And that means the real value of the bond market has to get crushed by the Fed, Treasury, et cetera.
Okay, so that is funny that you mentioned that, because I wrote a piece about it when I believe it was on October 14th when Powell spoke, and he said, yeah, we're not going to do quantitative tightening anymore. I think it's a first step to another level of quantitative easing. My base case for a long time is that unless we get our spending in order, pause for laughter, because we're not going to get our spending in order until the bond market forces it. My base case has been at some point in time, people are going to back off our bonds, the demand's going to wane, and the Fed's going to come back and to support it, at which time the dollar gets crushed against the euro and the yen, who are doing the same sort of nonsense all the time as we are, but against real shit. And that's one of the reasons that gold's been so stellar over the last few years. Can you tell me what you think of that thesis?
I think it's correct, and I think it's already underway. I think one of the challenges as an analyst for this period of time has been, sort of the shell game they've been playing with quantitative easing, right? So in, I guess July of 2022, I said the Fed is going to have to pivot within 3 months. And based on what I was seeing. And I was 100% wrong about the Fed pivoting, but I was right for the wrong reason. In other words, it wasn't the Fed who pivoted. It was Yellen at the IMF fall meetings in October, who basically was told, fix this by our allies. And the dollar proceeded to fall 43% on an annualized basis in the next 3 months. And so the Fed kept tightening, but between that in October 2022 and then BTFP in early 2023, which they said was not QE, was not liquidity, but like every chart that you look at that's liquidity sensitive did this.
Can I tell you, when you said BTFD, was that what you're talking about when they open up the window for SVB and those banks and
exactly.
Out their balance? Exactly. I just want to make sure the people listening are following along, because everyone's not as smart as you, Luke. Anyway, go on.
No, so BTFP was, I think it was bank term funding something or others by the effing paper for us in layman's terms. And so you saw that continue. You then saw Yellen in the fall of 2023, when things got tight again in terms of liquidity for a number of different reasons, shifted issuance to the front end. And then in the spring, she talked about Treasury buybacks, which were not going to be too crazy. And Besant comes in 2024 and promptly doubles the size of the buybacks on a run rate basis that she had been doing, and doing a lot more of the, hey, we'll issue short-term paper where there's still plenty of liquidity and we'll buy the long-term paper. And oh, by the way, if you look at the Fed's balance sheet broken down by tenor, they have not sold any 10-year plus bonds on net for, I don't know, since 2020 at least. And really, they've barely sold any since 2010. So, the purists will say, well, that's just roll off. We're just reinvesting coupons. And again, I look at my Bitcoin doing this. I look at my gold doing this. I look at beef in the last 3 years, which is up 50%. I look at home prices, which are up, 50% in 5 years, even though rates are up a ton. And I go, they're like Tommy Lee Jones in The Fugitive, right? He's like, I don't care. Call it not QE, call it not. So that's been kind of the tricky thing, is that it's not been just, Fed leaves, Fed comes back, Fed leaves, Fed comes back. It's been Fed, Treasury. There's been a lot of obfuscation, but the beautiful thing is, the markets over time figure it out, sometimes pretty quick. Or I think there are better smoke signals or smoke alarms for it than others. I think Bitcoin's one of the best, but you're seeing the cost of real stuff that you need go up as a result of this. You're seeing political responses, et cetera, and that's a separate issue on some level. But no, I think that's exactly what we are already well into. And to me, I think it's accelerating and likely to continue to accelerate.
I'm going to go ahead and explain one of the things Luke said there in an attempt to get people to think that I'm as smart as Luke, by saying the Tommy Lee Jones was from The Fugitive when Harrison Ford said, I'm innocent, and Tommy Lee Jones was hunting me. He goes, I don't care. Because he was hunting him either way. So everything that Luke said absolutely could have come from my brain, obviously, because I know the movie reference. I also want to point something out here. I got one of those conspiracy theories on Grok today. I asked a question about quantitative tightening. I didn't remember if the Fed actually gave a date when they were going to end quantitative tightening.
No, a couple of months.
Here's what Grok said. The most recent FOMC meeting concluded on October 29th, and they announced their intention to stop, or to fully stop effective quantitative tightening on December 1st of 2025 to stabilize the balance sheet of about 6.5 to 7 trillion to align with the 25 basis point rate cut they also confirmed on October 20th.
That's interesting.
I then asked what the stock market did immediately after that announcement on October 29th, and it said, our mistake. That hasn't happened yet. Hold on. And we went back and said, no, it's not been announced yet. I was like, just missed it. If I just would have asked a longer question as to what was the stock market result
Right?
after that, this would have been my last podcast recording. Absolutely would have been my last podcast recording. So yeah,
It's
Grok
funny,
confirmed
these
that
things.
quantitative tightening stops on December 1st. I'm saying that first here. The question I wanted to ask you, you mentioned something about during that particular period of time, your Bitcoin was doing this and your gold was doing this. What do you make of? I don't actually know your stance in a nutshell on Bitcoin. This is a two-part question. I should know it, but I don't. What did you make of recently when gold continued to go parabolic and Bitcoin kind of went sideways? And now they're converging. One of the things I said in a podcast that I did on Cypherpunked recently, who has their studio down here in Southwest Florida, I went and did their podcast. And I said, one of the things I can't get out of my head with Bitcoin is that the Bitcoin maximalists say that it cannot go down. And anytime I hear something like that, I'm like, okay, I'm not going to sell it, but it can go down. What is your stance on Bitcoin and what did you make of it when gold still was going up and Bitcoin wasn't? Does that mean that Bitcoin or gold is not acting on pure debasement?
So I like Bitcoin a lot. It's one of my biggest positions, has been for a number of years. For me, I'm torn on whether what that meant. I think sort of the short term Occam's razor explanation is that essentially it trades with the Nasdaq in the short run. And the Nasdaq, I think, has been sort of, in terms of how it is traded up until, just recently, it's sort of been consolidating. Bitcoin's been consolidating. And so I think on a short-term basis, it is a Nasdaq tech stock trade. I get that. Once you scan out a bit, it vastly outperforms the Nasdaq over the last 5-10 years, but it rhymes nonetheless, right? It's sort of, Nasdaq, 1.5 or 2 beta, right? Something like that. So I think that's part of it. I also have noted that at least in recent years, it's been a case of like gold goes and then Bitcoin goes and gold goes and then Bitcoin goes. And so, that could be part of it. But then there's also, I'm aware I put a tickler on my calendar a couple of weeks ago that sort of we're coming up to the end of this 4-year cycle that Bitcoin has abided over the last, life to date, basically, which is sort of, if you remember 2021, Bitcoin peaked at like 61 or 66,000, sort of like intraday. I want to say it was early December because I was down at Cincinnati watching the Bearcats win our conference. I was like, oh, look at Bitcoin. And then I was like, oh God, look at Bitcoin. But that 4-year cycle has kind of abided, right? You saw it at the end of, 21, end of 2017. I don't remember it back, I guess, end of 13. Yeah, it would make sense too. So it has abided this 4-year cycle. And I think there's some well-earned concern about that, right? Is this sort of it? So I think it's sort of all of those factors. Let's see. My base case is that it will catch up to gold and that, the liquidity that we need that will help the NASDAQ like we're seeing today. But
by the way, when we do hand signals to each other, Luke, that's just for us. You keep talking. Yeah, nobody wants to hear our bullshit. Okay, go on. I want to hear your bullshit.
So I've been in an email conversation with a friend of mine, guy who actually trained me pretty early in my career. And he thinks it basically, he thinks the easy money era is over. A lot of people think that. I'm not sure if I agree with that. But he said gold's move to him was more about seeking pristine collateral. And Bitcoin is not pristine collateral. And he thinks it has something to do with the, let's call it a 231% decline in the repo facility balances. So do you see anything there that sort of triggers you in one way or another?
I don't know is the short answer. The Bitcoin, or excuse me, gold is within sort of the banking regulations as, at least in some ways, collateral that it can be used. There's a haircut. I'm going to get this wrong, but it's like it is 0% risk weighting on a credit basis, but from a liquidity standpoint, I think it gets a haircut as treasuries are 0% risk weighted and no haircut on liquidity, which is sort of bullshit anyway, because gold's at least as liquid as treasuries, certainly in recent years, and probably more liquid, but that's neither here nor there. I just don't know. It's very possible. I've seen it hypothesized that China's been buying gold from a collateral standpoint, basically that they have an issue I've wrestled with that, and that doesn't make intuitive sense to me because historically, when you're giving, dollar liquidity tightness, you end up selling gold to raise dollars. We saw this in the late 90s in Southeast Asia. We saw Russia do it in the late 90s in their crisis. You've seen it in the bottom 50% of Americans over the last 20 years who dump gold at We Buy Gold stands to get dollars, right? So I can't figure out intuitively how China buying gold is a collateral move unless it would be hugely important if this was true, which is that basically it's now a gold collateralized system and they are valuing gold as collateral at a rate in real terms, dollar terms, something. They're valuing it above market. And then you would be waving it as fast as you could. That would make sense. And that would be sort of a dollar threat slash, squeeze to, Western gold markets if people were off sides. But I just, that's all speculative. I just don't know.
So I love that you brought up gold and I love that you brought up China because it brings a whole multitude of questions. I'll try to pin it down to one. When I was on with Maria this morning, I don't know what it just kind of popped into my head is a bear case for gold would be if we actually do get together with China, hug, kiss, make amends, and China then resumes buying treasuries, meaning their need to buy gold would be lessened. Perhaps that would be this, the straw that pushes some of the more weak hands out of gold. So I guess my question just is one, is that thesis interesting about gold and where it's going to next? Is the fact that Trump and China have announced some framework, in Bobby's words, for about the 8th time over the last year, a framework has been announced. So if you're putting all your chips on that square saying the trade war is over, I would warn against that. I'm not talking to you two. I'm talking to anyone watching. But what do you think of those things?
Yeah, somebody said recently, to me, for the top to be in gold, I think you have to answer yes to the following two questions. Question number one is, do we think that the United States military is willing to allow China to build more and more of our defense base for us in return for treasuries, as sort of has been the deal? So that's number one. I think the answer to that question is unequivocally no. I don't think we are ever going to allow that to happen. That's done. Question number two, yes or no, is do we think China and Russia will, one way or another, install Boris Yeltsin-like leaders that will essentially sell off their country's assets for pennies on the dollar to American interests like Yeltsin did, and then sign up to finance our deficits at negative real rates, which is the only way we can make our math work? And I think the answer to that's unequivocally no. And so to me, I agree with your premise that if by some way there was a trade deal that was done and it sort of did take us back to, ex ante the deal of they buy treasuries at, negative real rates and, et cetera, that sort of chimerica trade deal of 2001 through, I don't know, 2012, 2015, 2020, wherever you want to date it. I think there's near zero chance. You can never say never, but I think there's near zero chance that either one of those questions will be answered yes anytime soon, or really ever again. And so, as long as that's the case, I think we'll get corrections in gold. But I think gold in America has turned from a sell the rips asset to buy the dips asset, and I think most investors in the U.S. are still of the mindset that gold is a sell the rips asset, sort of the 1980 through whatever 2020 world we all came of age in. And it's now much more like an Argentina / Brazil / India, where gold in their currencies looks like friggin' Apple, up and to the right with pullbacks.
So you've hit on my two of my favorite dollar hedges, which was Bitcoin and gold. And it sounds like you agree with me that they can exist. These people who think they have to choose one or the other are so incredibly missing the point. And it's just something weirdly psychological of them. They both can exist in a portfolio together quite comfortably, along with real estate, platinum, palladium, silver, all this other shit, hard commodities, if the Fed is going to let inflation run about 2.7, 2.8% for the next year and a half, which, by the way, yes, they are. That's why we're celebrating 3.0 CPIs, because the Fed on an adjusted average wants 2%, which means a lot of running it hot. Does anything I said there make sense, right?
Absolutely. I agree completely. And I think, when you're running a portfolio, I would argue layer on just that having gold and Bitcoin and their relatively different volatility rates, notwithstanding gold for the last 5 days. But, up until 5 days ago, gold's vol relative to Bitcoin's vol, right? They're kind of the same trade. And, Bitcoin is the rabbit and gold is the tortoise, and they're both helping you. And in days like and vice versa. Days like today, where, in the last couple days where gold gets hit and there's kind of a rotation towards NASDAQ and more traditional, Bitcoin does well, really outperforms there. So over time, I've not graphed it, but I can just kind of see in my own portfolio of just like they work together. They're very complementary. You layer in some silver, some palladium, some real estate. Like at the end of the day, I think the most fundamental thing is the US and the West more broadly, they cannot afford positive real rates on their sovereign debt without going into a debt spiral. And they cannot afford to stand aside and go into a debt spiral. And even if they do, by the way, the best thing you want to own in a debt spiral is gold because it's nobody's obligation. So yeah, I absolutely agree with your view there.
Luke, do you think the fact that the Bitcoin volatility has dropped from 80% in 2020 to between like 50 and 60% now, and gold is still 14 to 16%, do you think people have completely lost the plot in terms of risk adjusted returns versus returns? Because that's, again, I talk to Bitcoiners a lot. And I do own some Bitcoin. I own more gold than I own Bitcoin, relatively speaking, because I own a lot of physical gold. I bought my first gold coin in 1986. So it's just been a thing. I just thought it was a cool coin. And, I wasn't investing back then. At least I didn't know I was. So does risk adjusted return come into play? You say Bitcoin is your number one holding, but it's not the best risk adjusted return over the last couple of years, is it? Or am I just doing my math wrong?
No, it's not. I think I saw a chart on this the other day. There was a ranking of Sharpe ratios, and it was like
Interesting.
gold was like the Tom Brady of Sharpe. It was like it had a 4.0 Sharpe. I don't know if that was year to date, but it's like, I mean, that's like a friggin' unicorn. Like it never happens. And so for the audience, Sharpe is just it's a measure of unit of return per unit of risk, basically. So it's sort of a vol adjusted return metric. So, yeah, when I say Bitcoin's my biggest, it ain't biggest by much.
Okay. Is it biggest because of the rise?
Yeah, it's big. Yeah, the rise
That's
it
what
had
happened to
in
Jim,
particular,
too.
so
Yeah,
sort of
mine too,
22 to
right.
24, and I've just kind of let it ride. But it, I wouldn't say they've lost sight of the vol adjusted, right? When you hear, you hear guys like Paul Tudor Jones talk about, vol adjusting his gold and Bitcoin relative holdings, and so I think when it sort of guys that are used to, making their money trading month to month, I think are absolutely still focused on that. I think people in the Bitcoin world have sort of come up like that's their world and it's just sort of normal for them, right? Like I talked to a
Yeah.
Bitcoiner that had gold was down 4%, and they're like, gold people are losing their minds. And like, this is just Tuesday for for Bitcoiners, right? Like, so we call this down 4%. We call Tuesday.
So I brought up that fact to somebody, and obviously he's a younger person, and the first thing that came out of his mouth was, "Okay, boomer." And I tried to explain to him that like none of us on this show right now are technically boomers because 1964 was the cutoff. So if you're 65, 66, or 1982 with you, Luke, whatever year you were born, you're not a boomer. That's number one. Then again, I did this podcast, and they of course clipped this part. I said, Bitcoiners have to stop acting like assholes. And of course, that's the promotional clip for the podcast, right?
But it's
And I'm
true.
standing there, I'm like wagging my finger. I'm like this,
You were a
wagging it.
boomer.
And that's the one
Get
they
your
use.
ball out of my yard.
Yeah.
It's
You're,
my
you're
ball
lucky
now.
they didn't call you Karen. They're
Yeah,
just, they're
exactly.
gonna
I'm
call
a
you a
male
Karen.
Karen. I'm a Marin.
Yeah,
I don't know.
yeah.
Anyway, what I'm trying to understand in this conversation is you're a proponent of holding Bitcoin, and I am too. I just acted like such a jerk on that podcast, such an angry old man. I'm trying to understand like what I want Bitcoiners to tell me what makes Bitcoin go to zero or to $10. When I asked that guy, I said, it can go to zero. Whenever something can't go to zero, I say, yes, it can. And he goes, well, it can't because I have very large bids at $5. Okay. Well, you could lose 50 to 80% on your $5 buys. So you, as someone who, you balance your portfolio out, whatever periods of time you do that, what can make Bitcoin collapse, if anything, if you believe anything can?
No, I think there's a risk for something like some sort of quantum breakthrough would be some sort of, and that's sort of above my pay grade from a technology standpoint, but that is theoretically something that, you could have an overnight collapse where, hey, somebody was able to. Now your game theory is if you could use quantum to sort of crack it, the smart thing to do would not be to break it all at once, but to steal a little bit at a time, basically.
We all saw that movie, the Imitation Game, not the Imitation Game, the one about touring, right? When they broke the Germans' code, but they couldn't use it all at once. The one where they bend the computer. Sorry, I'll shut up.
Yeah, no, exactly. So yeah, the optimal is to kind of bleed that. And so that's one way, if that found out, that would be a problem. I think another problematic area is, I think something we may have seen in 21 where, the US government was rumored to be selling, right? So if they came in and they've got what they've got, look, it is a pretty pure market still. For all of us that love, pure markets, it's still a pretty pure market. So when size comes up for sale,
it's unbelievable.
It's just, it's just like, take it and bid it, take it, or give it, and just white, So now those should be, but those things, as you know, because it does trade technically, it takes a long time to repair levels. We saw that in 20, 21, 22, whatever. So that doesn't wipe you out, but that hurts. The other thing that could really, I think, drive it down on a more sustained basis is if the political environment got to a point where it forces people to make what I would call a business decision, which is something a la FDR with gold in 33, where he made owning gold illegal for 40 years. As an American citizen, you could not own gold without being a criminal from 33 to 74. So do I think that's going to happen? No. Do I think we could get to a fiscal situation in this country where, look, we're already are in sort of a path domestically, politically, fiscally, that's not in a great area, really across the West. And so, is there a world where they go, listen, Bitcoiners are making too much money or they're whatever, and we are going to close the on and off ramps, right? You can own Bitcoin, but you can't get in and you can't get out. And it's the Hotel California. And if you try to, you're a criminal. Now you got to make a business decision. Do I want to stay in the United States? And oh, by the way, if you go anywhere else and don't rescind your citizenship, I'm not a lawyer, so I don't know this for a fact. I'm just speculating, but it may be difficult. There are places you go to Switzerland and say, "Hey, I'm an American." They'll be like, "Get out. We don't want your money," because of FATCA. So I don't know if that kind of thing would hold in the case of a Bitcoin, where if the government said, look, if you transact in this, we will find you. And if you use our rails, there are ways around that, but that it creates frictions, and that would be potentially problematic. And then people would have to decide what they want to do. Personally, I think it's horribly offensive, and I would not be a fan of that as an American. But look, I've seen our government do a lot of dumb stuff in the last 30 years.
So these I didn't mean to turn this into a Bitcoin show, Luke, and I apologize for that. But this idiot Eric Swalwell, who just came out and said anyone who's elected in 2028 that's a Democrat, from day one, they need to tear down the ballroom. And I immediately thought how entrenched the Trump family is now with crypto. That could be a way that they attack him post 2028 if they want, if they were to actually win. They say, okay, the Trumps are entrenched in the crypto community. Let's attack the crypto community every way we can, which just popped into my head now as you're talking about, the gold event from, what was it, 30-74?
Yeah, 33 to 74. Yeah, you could do that. And the Biden administration was very anti-crypto, very anti. You talk to people in the Bitcoin world, they were doing all kinds of stuff that was really anti-American, really profoundly un-American in terms of freedom of capital movement, et cetera.
Can I add something to that real quick? Because there's something that was fascinating that happened to me when I spoke at a Bitcoin conference the summer before last. And it was at the Austin Convention Center. It was enormous. And I was sitting in an audience after I spoke, 5,000 people probably listening to the speaker. And the speaker asked these people, where do you put cryptocurrency on your list of voting, of things you vote for? And who puts it number one? Everybody but me raised their hand in that conference. So, by the way, I think that's one of the reasons that Donald Trump won, because of his favorable opinion towards Bitcoin. That is an enormous voting block. I love this Bitcoin conversation too, but if it's okay with you guys, I'd like to pivot it over to tech stocks, because last time we spoke, which I think was last February, because I was in Florida, and we talked about tech stocks and China ownership. But a quick side note too, if Luke said something about these things are going higher, I was selling a property about a week ago, and I was talking to my accountant about capital gains, and he goes, well, let's find you some capital losses you might have. And I'm like, Howard, it's 2025. Nobody has any capital losses. Do you think I've owned Beyond Meat for 3 years? Is that where my capital loss is coming from? Anyway, you made the point last year that China owns a tremendous amount of tech stocks, of our tech stocks, US tech stocks. Do they still? What do you think the future is? Is this new potentially trade relationship going to be a tailwind for tech stocks? Have they had too many tailwinds up into this?
I don't know where they sort of still are on that front. Back in, I guess, February when we talked, we had just rolled out that, the U.S. had just rolled out that, it was called the something America investment memo or something. But it was basically China, take your ball and go home, right? Basically, the deal was we send you our jobs and our factories and you send us stuff, we send you dollars, and then you recycle the dollars into first treasuries and more recently stocks. And we were basically saying, we're done here. We don't want you buying our stocks anymore because, you've ripped us off and all the things that we've said. And so, which is fine. That's a decision we can make. I don't know where they stand on that front. You can see, in March, it started a bit, but then obviously post April, there was an extremely compressed, pronounced capital flow out. A capital outflow trade, right? Dollar down, stocks down, bonds down. That's, somebody was taking a lot of dollars and taking them elsewhere. And I think we've seen that continue to some extent, a little bit slower kind of bleed. The dollar is sort of traded around whatever, 96, 98, 99, 97, kind of area. Bonds have been fine. Stocks have been fine. So I don't know where that is. With that said, if you look at aggregate levels of the net international investment position, or NIIP, which is just the measurement of what do foreigners own of our stuff, of our assets, versus netted out against what we own of theirs, you can see very clearly the net international investment position. When it moves towards zero, they're basically degrossing out of U.S. assets. And when it gets bigger as a percent of GDP, they're regrossing, they're buying. And so they massively degrossed in 1Q and into 2Q. And then it looks like it is starting to re-widen again. In other words, foreign capital has begun recycling back into dollar assets. Now, that's value, not units, right? So some of that could just be, hey, the markets, to your point, everything's up. But that net international investment position from a value standpoint is still, we go back to 2007 or so. I think it was maybe -10, -12% of GDP. In other words, foreigners had 10 to 12% of our GDP more here than we had there. That number's like -81, 85% of GDP. It's enormous. Would they own $62 trillion of US dollar assets gross, $27 trillion net? Where I'm going with all this is that when we talk about the potential for a deal, and that's why I say gold hasn't topped unless, if we say yes to either of those questions. If we sign a deal where the deal is, listen, China, you're gonna make stuff for us again, and we're gonna sell you shares in our tech stocks as a result, then there's probably less need for gold, and tech's probably gonna outperform as China buys up the NASDAQ and then steals the technology and then beats us with our own technology, which is sort of what they've done for 25 years everywhere else. Are of the view, which in my view, it seems very clear that we do not want that arrangement to continue, then the surpluses that China is still driving in, presumably mostly in dollar terms, because the dollar is still the global reserve and most used currency, then they've got a bunch of dollars that they can't put into the NASDAQ, don't want to put into treasuries, can't put into farmland, can't put into, they may buy some in Europe, but there too, they're sort of increasingly persona non grata. Maybe they'll buy some in Japan, but you're left with like, okay, well, I guess we'll just buy gold with it. And that's why I think ultimately you've seen them continue to buy gold, even though they've had, in theory, dollar shortages or what have you. Hard for a country running $1.2 trillion surplus, trade surplus, to have a dollar shortage in the true sense of the term. But that's not an answer, but it's an answer. I think ultimately they probably maybe on the margin maybe they're private entities, but especially in the hindsight of this Nexperia thing in Europe, where they just grabbed the frigging company, like that's very dangerous. To me, that's the Nexperia thing was a great buy gold and buy Bitcoin ad.
No doubt. So the gold trade, I surmise this is that for the last few years, guys like us were buying gold. It was based on the stewardship of our currency was shit. Plus, global central banks were buying gold at rates they hadn't done in 80 years. It seemed like to me earlier in the fall that changed materially. JP Morgan came out and said it should be 20% of your portfolio. Ken Griffin, not David Gundlach, Jeffrey Gundlach, they all came out and started talking about gold. I think the trade immediately fell down to the retail level, and that creates the next leg up, but also huge volatility. And it did just that. And now volatility, I think it could easily pull back to even 3,600. Do you think the retail is going to get whacked and then it's going to resume back the trade, the fundamental trade that we had on?
The short version of it is yes. I think you guys know the charts better than I do. Once you get, sort of vertical charts, once you get that far away from your important moving averages, like this is what you get. And I think between retail and I also think sort of the levered traders, if I want gold higher as in the US, like I want retail, if they're buying coins, great. Buy the coins. I want you to make money. If I'm Scott Bessent or Donald Trump and I want gold higher for a number of different reasons that were I think they do. I don't want the hedge fund community, the levered hedge fund that's not buying gold or buying paper. I don't want them getting rich. I want this thing to pull back from time to time and sort of, keep. So I think both from sort of the speculative retail and the speculative hedge fund community, I think they want to sort of have washouts that kind of keep it clean, for lack of a better word, right? It's, more physically, fundamentally based versus just, let's run this thing into an asymptote so it's like bending back on itself. That's yeah.
That makes sense. So, okay, the next question about tech and about the bubble. I have been saying that it's a bubble, which, by the way, is worth nothing. Bubble can go on for 2-3 more years easily before. And just to put that in perspective, in 1999, the PE of the NASDAQ was over 200. Now it's 35. The PE of the Magnificent Seven is stretched, sure, but they make shit tons of money, so it's not that stretched. Do you agree with me that the fervor and enthusiasm that has come into the AI trade at some point in time is going to smack people in the nards? And yes, people, I will try to work nards into every show that we do. We're not professional. What do you think, Luke?
The short version is I do agree with you. I think the conditions up until just recently, right? So two other times in my careers, I've been in finance for 30 years, my goodness. And it reminds me very much of two other times. The first time was during the telecom boom, if you remember that, right? These telecom guys all were borrowing a bunch of money, laying a bunch of fiber, had to keep the fiber lit, and were burning cash because they didn't have enough paid traffic through the fiber. And it got even worse, allegedly, when Metallica won against Napster and all the songs stopped going through the fiber. And then, capacity utilization really fell. And, these guys basically all went bust because they had borrowed a bunch of money and were running massively negative cash flow. So when the credit markets started tightening up, I want to say like early '02, mid '02, something like that, it was disaster. That's sort of the first time it reminds me of, sort of. The second time was the US shale bubble, right? So if you remember, we saw, drill more and faster, and it was very much the decline rates of these shale wells are very extreme, right? So it's, you get all big, huge production first 3 months, big tail, or big decline, and then long tail. And they were initially doing this all on borrowed money. Once you start doing on borrowed money, your incentives are, oh God, I need cash flow at any cost. And so we're drilling unprofitable wells to generate cash to pay the old loan. Same thing. Oil prices fell. Everyone gets washed out. Boom. The dynamics of this, we need to invest more and more into the AI and data center because we are falling behind because it is the obsolescence cycle is so short, is very reminiscent. The one thing that up until recently has been different is it's all been being funded out of either equity or out of retained earnings, right? They are not they have not up until just recently been borrowing money. In the last couple of months, they're starting to borrow money. It's not widespread, but you've seen Oracle do some, multiple billion-dollar deals, and I don't have an opinion on that stock one way or another, but you've seen some others do it, and you've seen some of the, we'll call them creative, I'll be non-inflammatory, creative ways of vendor financing some of this stuff from like the old days.
OpenAI?
You buy this and you buy this, and we all lend at each other, right?
People.
So you're starting to see some of those things, but there's two things. Number one, there's not been a catalyst. And number two, there is a national security impetus here that did not exist in the case of the telecom thing or in the shale thing, where, number one, the DOD is not going to let this thing do what shale did from 14 through 16, and they're not going to let it do what telecoms did from 02 to 05. They are going to step in and they'll buy up everything. That may or may not mean like the businesses aren't going to go away. That may not mean that you won't lose a lot as an equity investor in those things. Those are mutually exclusive. The other thing that is different this time to the negative for the data center hyperscaler thing is China's a real competitor. And so we were the biggest marginal oil producer in the world in shale, right? There was sort of no other, it wasn't like Argentina was trying to come on with the Vaca Muerta shale or whatever, or something like that. The Europeans had nothing, etc. Same thing, back in '02, there was like it was us in tech and nobody else. Like any given Sunday, like China could come out with something with DeepSeek, like they kind of did earlier this year. And that could be one of these holy cow moments where all of a sudden everything can change and hundreds of billions of dollars of capex you've already made become obsolete in a hurry. And that's, you know, I'm not saying it will happen. For me, how I like to run my money, I don't like to live that way. That's, I've already lost enough here. I don't need to be, huge, and that moment may not ever come. I just don't know. I don't have the background there. But look, I have people I talk to in that world, and someone last week showed me this AI leaderboard. It was, hey, here's this AI leaderboard ranking the various performance on what are probably objective metrics. Who knows? But and half of them are Chinese and half of them are Americans out of the top 10. And you kind of go, it is this is a national race, right? These are two, 1,000-pound lions fighting each other for dominance. And I'm like, a little scrappy chihuahua. I just want to stay the hell out of the way.
Luke, I wanted to couple things. First of all, I want to mention something here, Jimmy, that was put up on Twitter from our buddy. Where is it? Ed Kernan, sorry. Jim, in reality, is a boomer because of his older siblings who raised him on the small homestead.
And my dad was a World War II vet, our family. Yeah. And so I missed it by a year, but I've seen some, what do you call that study of whatever humans, some say that 65
study of humans
could be boomers too. Whatever. Forget it. You guys go.
He's like the last of the boomers. He's like Daniel Day-Lewis.
I'm the last of the boomers. Damn straight.
So I'm actually the guy who can tell you to shut up, boomer, when I want.
Shut up, boomer.
Shut up, boomer. Jim Bianco posted, and I thought this was interesting while this show was going on. He said, I'm a big fan of Two-Way TV app. I don't know who that is, but I'll probably check it out as soon as we're done with the show because Bianco watches it. They offer a differing opinion as to who's going to replace Powell. Now, this is obviously, we're talking about a May event, right? May of 2026. Scott Bessent, Kevin Hassett, and a long shot of Marin, right? Steve Marin, the newly appointed Fed governor. Who would you go with on that? And remember, keeping in mind that we have the midterms right after that. So it seems like Trump would want like 9 rate cuts just before the midterms to try and secure that election so they could really do what he wants to do.
Bobby, that was the opportunity for you to do your Trump. You've been working on it. It's good.
I think we need 9 rate cuts. We need negative 25 basis points. Just before, then when we get that done, we'll really do some things. You'll see. Anyway, go ahead.
That's a pretty good one.
It's not bad.
Getting better.
Pretty good. That's pretty good. Yeah, mine's better. Mine's pretty good. I want rate cuts. They're the big, beautiful rate cuts.
You do the hands better than that. I got to do the hands.
I'm the master of rate cuts.
My favorite thing is when he's reading off a prompter and then he goes off of it. We believe this partnership, and it is a great partnership. It's going to be the best we ever saw. We believe this partnership. You can tell when he goes off of it. It's amazing.
That's a really good one.
Anyway,
yours is good.
Who's your pick to replace Powell? Do you have one? Do you care?
Let me say from a meta standpoint, for me, I think the most important thing is to stand back and acknowledge what we're watching here, which is Powell is being given a goal to the lead decision. Either you monetize this reshoring and you repress Wall Street and the bond market, or we will find someone who will. And I think that's the number one thing here. Number two is it Bessent or Hassett or Myron? I think they'll all kind of do the same thing. Obviously, Bessent might be the most aggressive because, what do you think? Well, I think we should cut 75 basis points. Yeah, me too. That sounds good.
I really call this Bessent's economic presidency. I really do.
Yeah. But I would probably go Myron, Bessent, Hassett, but I mean, Bessent, I'm pretty sure gets it. Myron gets it very clearly with some of the stuff he's put in white papers around. So I think both of them really, really kind of get what the strategic goal is right here, right? This is no longer, hey, we need to maintain our employment versus our, and our inflation metric. Like this is in 5 years, China's going to make everything for us and dictate everything to us unless we, crush the dollar and crush the bond market for 5 years and actually start making something again. And so I think all those guys will follow that metric. So to me, I don't have a strong view one way or the other.
Can I jump something in here? Because I'm about to say something, and I think the two of you are going to disagree with me. Because here's what I think your opinion would be right now, and I'll get to it and let you say if I'm right or wrong. In a time where Beyond Meat is rallying 250% in a day, and everything's at all-time highs, it's probably the wrong time to be easing. And I was always of that belief. Now I'm thinking this, is that Amazon just announces today that they're getting rid of 30,000 employees. I assume part of that is AI filtering in and having that disinflationary effect that technology often has. I also think that the supply side solutions to inflation that Trump and Stephen Moore and Larry talked about, which is allowing companies to produce, getting rid of some regulations, could be affecting, in 2026, affecting inflation from the supply side. I think there's a chance that Jerome Powell is looking at that horizon and thinking there's a lot of disinflationary things coming around, might as well get ahead of it. Tell me how wrong I am.
I think it's possible you're not wrong. So like something I've been spending a lot of time writing about and wrestling with is this AI thing, right? So I didn't see the AI Amazon news today, but I wrote
just came
last
out
week.
like as we were on, it just came out. Yeah.
Okay, yeah, they had something in the New York Times leaked documents last week. They said there were 160,000 employees that Amazon was not going to hire by the end of 2026 because of robots. 600,000 by 2033. I'm getting pinged by people saying that within 2 to 3 years, robots are going to be cheap enough where small guys that pay the full freight, the retail price for these robots, not wholesale like an Amazon might, for example, are going to have to invest just to stay in business. And it's going to wipe out half their workforce. And so there's very much a non-linearity to this that I don't think a lot of investors are there for yet. And what I've been focusing on is this stuff is fundamentally incompatible with our entire debt-based monetary system, right? Like in 1990, it was a New York Times had an article earlier this summer. It showed 1990, I want to say like 35 or 40 of the states, U.S. states, biggest employer was manufacturing.
Right.
And then we want to get out of there, dirty, low margin, blah, blah, blah. We're going to go to services. Great. Today, 38 of the 50 states in the U.S., the biggest employer is healthcare. And it's not been docs and nurses. It's not been practitioners. It's been administrative. And there are very few sectors, in my opinion, that are more uniquely suited to being disintermediated by AI than healthcare administration, right? Billing, claims. Like AI can do this stuff way better, way cheaper. And all these people have mortgages and they all have car loans. And you would expect to start seeing it in the young people, right? Fire someone you have now. You just stop hiring new young people because this stuff does it better than the young people do it already. Unemployment, and Wall Street Journal had an article about a month ago, unemployment amongst bachelor degree holding 20 to 25-year-olds, 20 to 24-year-olds is 7% already. If unemployment in this economy was 7%, kaboom, it's over.
Yeah.
Seats are down 20, 30%. The U.S. interest plus entitlement bill is at least 120% of receipts, and the Fed immediately faces Treasury market dysfunction where rates are going to be going up like we saw in 19 and in 20 in COVID and in 22 and in 24. And they're going to have to print a shit ton of money just to control the Treasury market. So like, gotta believe if Luke in Cleveland is reading these things and seeing these things, he's got resources that are probably alarming him on that front. So I don't think it's crazy. And the thing we've been saying to our clients is, to me, the best way to play AI, the best chicken way, especially if you don't want to get into the weeds of like, okay, is DeepSeek better than ChatGPT or is Quen better than Perplex, is whenever it hits, right? The debt is doing this, right? Exponentially, and AI is doing this exponentially. And robotics. And we're
going to the workforce, you mean, right?
Correct. Yeah, it's very deflationary, but also to receipts, which means then, like when they stop paying their mortgages, are we going to stand aside and let AI put JP Morgan out of business? Of course we're not. We're going to print all the money we need. And oh, by the way, what do the U.S. banks hold as their reserves against credit losses thanks to the last 10 years of regulations? Treasury bonds. They're going to be selling treasuries into a recession. So the Fed's not going to let that dysfunction. We know that has been firmly established. So you're getting this situation where you need exponential nominal GDP inflation to keep the debt sustainable, right? Negative real rates. At the same time, you're getting exponential. You're starting to see the exponentials of this AI and robotics thing. And the gap between these two is the amount the Fed's going to have to print to keep the system from collapsing. And pretty quickly, within 2 years, you're going to go like this. And the amount they have to print is infinite.
You're going to keep me up at night again. Jesus Christ, Luke, because it's so true what you're saying, but it drives me nuts because this, and again, for my whole life, I hate when people talk about technology. Oh, it's going to eliminate jobs. This technology really is going to eliminate jobs. The rest of them created tons. This will create some, but the ground is shifting under our feet at an alarming rate. So how do we as asset holders, because again, I want things to work out for everybody, but I'm going to work my ass off to make them work out for me, just to be clear on that. So the asset holders hold hard assets and tech stocks as well, right? That's the only solution.
I think it is. Like, to me, gold and Bitcoin are AI plays. I think they might be the best AI plays because I don't know who's going to win AI, but it's back to Tommy Lee Jones. I don't care who wins AI. They're going to have to print so much money to keep the banking system, the consumer loan banking system, from collapsing due to AI. They're going to have to fully reserve the debt. The Fed's balance sheet's going to have to go to a number that blows people's minds. And I think
people watching, we will never have Luke on our show again because he gives me nightmares. Bobby, do you have one more? Do you have another question for him or no?
No, do either of you think this wasn't just a buy gold and buy Bitcoin show? I mean, that kind of seems to be what it is. No, I don't have any more.
No.
Look, I've seen the technology thing. Like, to me, like my
The
mental model.
infrastructure of technology, not actual AI companies.
Yeah, just the deflationary nature. I have a mental model for this, right? Like I'm in Cleveland. I saw the first AI productivity miracle. It was called China in the WTO. And manufacturing jobs fell by a third. And, they were given subprime loans by Goldman to, buy boats and buy cars and everything. And so their living standards didn't fall right away. But that was basically just private UBI. And then when home prices stopped rising, guess what happened? The whole system came unwound. The Fed had to put it all on their balance sheet. Like it was none of the economists that write about China going to the WTO. Take note, they don't call it the China productivity boom. They call it the China shock. They call it the China shock because of what it did. It was, 1 million Americans died of drug overdoses from 2008 to 22. People need meaning. So there is, think what AI is. I mean, I worked at a regional brokerage firm, right? In 2004 or 5, we had 12 guys on a sales trading desk that were probably making $400,000 to $600,000 a year. Within 3 years, we had 2 guys making 150. And, that's when we went to programming trading. And basically you needed, you either were Goldman and you had invested $500 million in your program, your algorithmic trading for your clients, or you got out of the trading business. And those were like, there was no middle ground basically. And that's kind of the same thing here.
We definitely, us and everybody else that we consider, we respect their brains is the best way to put it, have been saying this is a white collar job killer. And we've been quoting you a lot, how you said to us, I don't know, 12, 15 months ago, that a plumber is going to make more than a managing director at Goldman Sachs at some point down the future, or a partner at Goldman Sachs. I don't remember your exact quote. No, the only thing I wanted to say, Jimmy, before you close it out is, I want to thank Luke for being on here. And I want to say the Unfiltered Investor newsletter, which you can find at unfilteredinvestor.com, is on a 7-stock win streak. Not hard to do when you're making new all-time highs. I won't overstate it. But since we launched the newsletter, we're about to publish our 30th issue, and we're at a 75.7% win rate clips.
Which, by the way, even if it was at a 49% win rate, it'd still be profitable just because.
Yeah, we never do less than 1-to-1 reward to risk.
Yeah. Anyway, Luke, one last thought I just want
to We are the biggest live stream right now on X, other than Trump seeking a third term. Democrats are panicking. That's the one funny one. And I've never seen more posts in my stream about how the Republicans have the House, Senate, and the executive and can open the government anytime they want. Completely misinformed, number one. And number two, that people are going to die because of the healthcare. Go on. I'm sorry.
Okay. No, let's drop it at that. Yes. I was going to make some comments about universal basic income and people needing purpose in their life, but you guys all know that it wasn't going to be any sort of great thing. Luke, thank you so much. I know everyone knows where to find you. Let's just say it to make sure. It's at Luke Gromen on Twitter, correct?
Yes, sir.
And the website to get more of your stuff is?
FFTT-
That's Forest for the Trees, in case you guys are wondering how to remember it. Thank you guys so much for joining us. Again, like I said, I'm not even joking. This is my favorite show to do because of the live element to it. Thank you guys for being part of it. Thank you, Luke. Thank you to our sponsors. First, Independence Arc. Eat real food. Don't eat processed bullshit. Eat meat. Eat it from Marco at Independence Arc. Oh, by the way, he's just pork now. He sent me a ham steak and we made pea soup with it last night. The ham literally melts in your mouth. It's fantastic. And as you guys know, Monday's my fast day. Bobby knows, Luke doesn't. That Monday I don't eat until dinner. So right now I'm about to kill somebody just for a bite of that soup. But anyway, thank you guys for joining us. Patronize Marco. Join us on unfilteredinvestor.com. This has been the Future's Edge. Thank you guys.
Thanks for having me on.